Good morning. Hope everybody's doing well. Just want to do a quick video, a quick live stream. Been getting a lot of questions lately about taxes. Basketball players playing ball overseas. Had a consultation yesterday with an individual who asked me about how to save money in taxes overseas, how to avoid paying a large amount of money to the IRS from money that you don't necessarily make within the U.S. And I got a little bit of information in my book that I released that speaks about that. So I just wanted to give a quick video on it and share some of the things that I know, some of the things that I researched, and some of the things I spoke about with a couple of my different CPAs that I have worked on my taxes in the past. And before I get into it, I want to just do a quick disclaimer. I am not a tax professional, not a CPA, nor do I claim to be. I just know a little bit of information from what I researched, what I studied, and what some of the things that I've done in the past to help save money in taxes. And I strongly encourage you to research, backtrack what I'm saying, look up some of the terms that I'm speaking about. Ask your tax professionals about what I'm saying, and do some research on your own. To try to figure this thing out, because this is how the rich stay rich. It's how the rich stay wealthy. That's how they protect their wealth. And that's how they get away with not paying too much taxes on a lot of money. So and another thing, if you haven't purchased my book, go out and get it. It's available on Amazon.com, iBooks, and Google Play. E-versions available on those three platforms: Kindle, iPhone, you got Android, whatever. Google Play, iBooks, Amazon is available for $4.99. Hard copies available for $15 on Amazon.com. Show some love, show some support. It's a lot of information in that book. Speak about taxes, speak about insurance, speak about building wealth, legacy, family, starting businesses, entrepreneurship, investing, real estate, and credit. Speak about all those different topics in the book. I touch briefly on each one, give you an example, go into detail a little bit about each one. And I've been getting a lot of DMs, a lot of emails from people who want me to elaborate a little bit more on what I spoke about in the book. So I'm just going to put this video out to make sure people have an opportunity to learn a little bit more about some of the stuff that I know and some of the stuff that I researched. Again, I encourage you to go out and research it on your own, and ask your tax professionals about what I'm speaking, just to make sure that I'm legit in what I'm speaking about. So how do you save money in taxes as an international athlete making money overseas? Well, I will ask you where you see yourself in the next 3 years as far as your living situation. Why is that important? Because depending on what you want to do with your living situation will determine what route you should take in trying to save money in taxes. I say 3 years because if you're trying to purchase a home and you're not buying it flat out cash, 9 times out of 10, you're going to need to do a mortgage. You're going to need to get a mortgage, and depending on your lender and the bank, they're going to ask you for a list of things that you need to provide in order to show proof that you can afford the house that you're trying to get. One of the things that they're going to ask you for is tax returns. Usually they're going to ask you for 2 years tax returns. Sometimes they ask for 3. Most of the time they ask for 2. So if they're asking you for 2 years tax returns, that means they want you to be able to show your income, how much taxable income you have, and the ratio of debt to income to show that you have that much money available to pay for your mortgage each month. Your mortgage is going to go from probably 15 to 30 years. So they want to make sure that you have a steady, reliable income coming in that can support your mortgage payment each month. And your housing payment, whether you have a mortgage or you're renting, is going to be probably the largest expense that you have, throughout your life. It's just the way it is. So if you're looking to get a mortgage, you need to start preparing for that for about 3 years out. So 2 years tax returns are going to have to show that you are capable of handling a mortgage for a 30-year period. So they're just going to base all that off of 2 years, which is kind of ridiculous, but that's just the way it works. So, good morning. How y'all doing? Hey, Aunt Janet. I'll wave back to y'all. Thanks for joining in. So we're just talking about overseas people, not overseas people, but people who make foreign income. I had a lot of players who asked me questions about taxes. How do I handle taxes? How do you save money on taxes? A lot of us just go ahead and pay $500 or $1,000 to a CPA and let them handle everything, and then they hit us back and say, yeah, your taxes are done, you're good. And we don't really, go behind them and check and see or ask questions about any of the stuff that they do. We just pay them and then we keep it moving, which is a bad habit. I think you should know a little bit more about the nuances of what's going on as far as taxes is concerned, because they change and stuff and they add new rules every year. So it would behoove us to, be more knowledgeable about taxes and exactly what's going on and how we can save ourselves a little bit of money and protect our wealth. And in turn, the less money you pay in taxes, the more money you get to save. So if you're buying a mortgage, if you're buying a home and you're trying to go get a mortgage and you have to show those 2 years tax returns, let's say, for example, you're making $100,000 overseas, you're making $10,000 a month for 10 months. All right, let's just use that number for an example. All right. What I would suggest is you use the foreign income tax exclusion or the foreign earned income exclusion, which is something that the government gives as an incentive to people who make money overseas or offshore or out of the country. Foreign income tax exclusion, foreign earned income exclusion. You should ask your CPA about that. If they don't know about it, you should probably go and find someone who does. The foreign income tax exclusion or the foreign earned income exclusion will allow you to write off up to $108,000 per year for that 12-month period for the year in question. All right? So it's not necessarily a write-off, it's an exclusion. So you can show that you're making $100,000 or more on your taxes and you don't have to pay taxes on that money. It's excluded from your tax liability. So every year they change it. They changed it due to inflation. So last year, 2017, I think it was around 106.8. Obviously, you could be making more or less than $100,000 a year, but they let you take $108,000 and exclude that from your tax liability. Now, when you're doing your taxes and your CPA uses this strategy, it's going to show that you're making that much or more, and you're not liable to pay taxes on that. So like I said, if you're making $100,000 and you're trying to go get a mortgage, and they're asking you to show 2 years of tax returns, and those 2 years of tax returns show that you're making $100,000 or more, that's all they want to see. But obviously, we try to write everything off. If you write everything off, then you're basically showing the bank that you don't have any expendable income. You don't have any income left over for you to afford a mortgage each month. That's not what you want to do. They're not going to let you go into buying a home or go getting a mortgage if they see that you ain't capable of affording it. You know what I'm saying? So that's really what it's about. So the foreign income tax exclusion or the foreign earned income exclusion will allow you to show up to $108,000 in your tax return, and you're not liable of paying taxes on that money. Now, if you're making more than $108,000 a year, there's also something that is included in the foreign income tax exclusion, which will allow you to write off money if the team is paying for your meals and they're paying for your homes. Now, most of us playing overseas, usually in our contract, it says that the team is going to pay for our home, our car, and meals sometimes, depending on if they have some type of deal with a restaurant or whatever the case may be. If you can get some type of documentation or some type of proof, receipt, whatever, to show how much the team is paying in an expense for your living, your car, or your meals, then you can also use that to write off the rest of your money. You know what I'm saying? So even though it's not coming out of your pocket, the expense is being paid for by your employer. So therefore, you can use that to write off the rest of your income, right? So these are some of the nuances that they put out there to help people who play ball overseas or who just work out of the country. Now, there are some qualifications that you have to meet in order to use it. They're not going to just allow you to do this for anybody. One of the main qualifications is you have to be outside of the country, or you have to be a resident outside of the country for 330 days. If you have a home outside of the country, or you're living outside of the country, there's no time frame, but you just have to show that you have a home and you're living outside of the country permanently. If you're not living outside the country permanently, then you have to prove that you've been out of the country for 330 days minimum. Now, most of us sign contracts that last for up to 10 months, right? August to June, usually. If you tell your agent to make sure that your contract is a length of up to 330 days, they can work out the numbers. You know what I'm saying? They can work out the numbers. So if you're going from August 15th to June 15th, or whatever the case may be, they can plus or minus how many ever days they want, just to ensure that you have 330 days outside of the country. If you're outside of the country for 330 days, then you are eligible to use the foreign income tax exclusion or the foreign earned income exclusion to write off up to $108,000 a year on your taxes. Not write off, but exclude that amount for your tax liability for $108,000 a year. So that's the strategy that I would use if I'm looking to buy a home. Let's say it's 2018 and I want to buy a home in 2021. I would start this season to gear up for 2021 to buy a home, and make sure that your CPA, whoever you're using, whoever your tax professional is, make sure they know how to use that strategy. Foreign income tax exclusion, foreign earned income exclusion. You're allowed to write off up to $108,000 per year as long as you're out of the country for 330 days, or you have a residence outside of the country, permanent residence outside of the country. All right, so that's for people who are looking to go get a mortgage or looking to buy a home. Another strategy that I would use for people who aren't looking to buy a home within the next 3 years, if you're renting, leasing, whatever the case may be, you living at home, whatever the case may be, if you don't have any plans to buy a home and you just want to save money on taxes and you don't want to have to worry about paying a whole bunch of money to the government, for money that you ain't really earning in the U.S., then I would use a number of different strategies. The main one that I would try to use is I would try to really utilize the strategies that most business owners use, because we are considered a contractor, independent contractor. When you're an employee and you get a check from your employer and you're working in the U.S., they usually take the withholding out of your check before you get it. The government takes their money first, and then you get what's left over. That's how it works if you're an employee. But since you are an independent contractor, you have the ability to pay the government after you pay yourself, or after you pay off all your expenses. You get to pay the government whatever's left over, right? So you need to utilize this strategy and help yourself protect your wealth as well. How do you do that? Well, what I would do is I would start a company. I would start a business. I would go get you a LLC or INC or whatever the case may be. I would prefer a LLC because it's a little bit easier to manage. Start an LLC. Make sure that it's some type of entertainment company, some type of athletic company, sports management, entertainment, whatever the case may be. It has to fit the narrative of your job. You're a professional athlete, so it has to be something that has something to do with entertainment, just so it makes sense. I would start a company, get you an LLC, When you get your articles of incorporation or articles of organization back from the state, take that, go to the IRS and get you an EIN or tax ID number. Once you get your EIN and tax ID number and your articles of organization, take both of those to the bank, open a business bank account. Open a business bank account under the company name, get your route number, get your account number, give that to your team. Make sure your team sends your salary each month to your company account, not your personal account. Get the team to send it to your company account. They usually will do it without no problem because it's still in your name. You still have your name on the company account, so it shouldn't be no issues with that. Make sure they send that money to your company account. Once you get that money in your company account, and you're an employee of your company and you're the owner of your company, so you can pay yourself a salary, but you don't necessarily have to pay yourself a base salary. The IRS states that whatever your industry is, you have to pay yourself a salary that's reasonable, but they don't necessarily tell you what a reasonable salary is for an entertainer or an athlete, right? They can't really tell you what a reasonable salary is. So you have to be the judge of that. What I would do is calculate all the expenses that I have each month, whatever it is, house, car, bills, lights, phone, whatever money that you usually spend each month. Figure out what that range is. Let's just assume that it's $5,000, ballpark. Let's say it's $5,000 a month that you are religiously spending every month on your expenses just to live, make sure that you're in good shape to play and enjoy your life, whatever the case may be. All right. So now you can pay yourself a salary based off of your expenses. So we know that when you have a company and you own a business, the tax liability does not fall on that business if you make sure that that LLC is filed as an S corp, which means that it's a pass-through entity, which means that the tax liability is passed through to the owners of the company. So however much money you put in that business account, the government can't touch it. The government will only come for that money once it's paid out to its owners or its members. So as an owner of the company, you can set your salary for whatever it is, for whatever you want it to be. Cut yourself a check. Your expenses are $5,000. Cut yourself a check for $5,000 each month. Put it in your personal account. Pay off all your expenses. Pretty much ain't nothing left over. So it's nothing that the government can tax you on, because they're only going to tax you on what's left over. Remember, you're a business owner. They don't tax you first. You pay taxes on what's left over. So if you're paying off all your expenses, there's really nothing left over for you to pay. When your tax professional files for you, they're going to look at your statements. They're going to write off pretty much all of your expenses as a business expense, because as an athlete, a lot of the things that we do day to day are business expenses. I wrote about this in the book. Our food, our meals, our travel, our housing, lodging, whatever. We buying shoes so we can compete in our shoes. We got gear. We got all these different things are there to help make sure that we are in the best shape possible in order to compete and do our job to the best of our abilities. So they all can be considered business expenses. It just has to fit the narrative, and it has to make sense. So every one of our personal expenses can be written off as a business expense. And most of us do that anyway when we file taxes. Most of our tax professionals do that anyway when we file taxes. But this is a different level of it, because now you don't have to spend all of your money in order to write all your money off. You can keep a lot of that money into your company account. Now, what you have to be mindful of is when you're keeping all that money in your business account, it can't just sit there and be used like a savings. There has to be some type of activity in the company account or in the company to show that you're not just using it as a tax shelter. A lot of people do, but just to be on the safe side, you want to make sure that you're doing some type of activity in the business. So, you can do anything. You can start a website, or you could go to eBay, open up a company eBay account and sell some of your old shoes on eBay, or open up you can do, it's a whole bunch of different things that you can do with it. You know what I'm saying? You could write a book. You know what I'm saying? You could put out an ebook or whatever under your company, you know what I'm saying, and then, sell a couple books. Just some type of activity to show that you are a working business. The government doesn't care where that money comes from once it's put into the company account. They don't care where the money comes from. They just want to know where the money is going, and whoever's getting the money is paying taxes on it. That's what they care about. So Whether you're getting your money from the team, or you're getting your money from book sales, or you're getting your money from shoe sale, whatever the case may be, they're not checking for that. All they're checking for is whoever's owning this company, whoever's getting paid from this company account, are they paying taxes, right? And if they're not, why? So you just got to explain why. Well, everything that I have is a business expense, so I don't owe nothing. Cool, you good. You know what I'm saying? So that's another strategy that you can use. Open up a company, start a company, get you an LLC, get you an EIN, open up a bank account, have the team pay your salary to your company account, not your personal account. Set your personal expenses, figure out what that number is, and then set your salary based on that. Pay yourself $5,000 a month, one time a month, or $2,500 two times a month, every other week, every 2 weeks, whatever the case may be. You work that out on your own. But for the most part, that's the strategy that I would use. Now, another strategy that you can use is if you have kids, if you have children, and you want to make sure that you are putting your kids in a good spot to where they have a nest egg or a good amount of money to go into when they turn 17, 18, 19, or when they go to college, or when they graduate college, or whatever the case may be. You can open up a trust account for your kids. We all heard the term trust fund, kids. But there's so many different types of trust funds that you can have, depending on your situation, or depending on what type of trust fund you want to go into. But I would look into opening a trust account specifically for your kids, so that you could put some money in there, and the government is there's no taxes on that. When it gets paid out and when it's sitting there, the government is not going to come for that money. So you want to make sure that you're picking the right one, and make sure that it fits the strategy that you're trying to use, years or decades down the line. Make sure that your kids is getting the right amount of money, and make sure that the government is not coming out of nowhere and just snatching that up as soon as the money is paid out. So you want to look into a trust account if you're concerned about making sure your kids are straight. But, you can also make your kids an employee of your business if you want, and pay them a salary as well, or open a custodial account for your kids, something that they can't touch or they're incapable of touching, and then pay their money through their salary to the custodial account. You can do that. But just to keep it simple, for those of you who are trying to purchase a home within the next 3 years, I would look into using the foreign income tax exclusion or foreign earned income exclusion to write off up to $108,000 a year in taxes. Not write off, but exclude the tax liability for up to $108,000 a year. And if you're not trying to buy a home, I would open up a company account. I would probably open up a company account regardless, because there are a lot of people out there who are making well over $100,000, and they want to make sure that they're not paying taxes on that as well. Open up a company account, put the money in the company account, pay yourself a reasonable salary, enough to pay off all of your expenses, get you some type of activity in the business to make sure it's legitimate, something that doesn't necessarily need for you to go and get a business license to operate for, and just bad connection. But yeah, that's pretty much it, man. I just wanted to drop that in, do a live video, and I will be reposting this on my YouTube channel. So if anybody wants to go back and listen to some of the things that I'm talking about, you'll be able to see it again on the YouTube channel. I will repost it on the YouTube channel. Go get the book, A Million Wins, Amazon.com, iBooks, Google Play, e-versions available, hard copies available on Amazon.com. Go get it. $4.99 for the e-version, $15 for the hard copy. And that's pretty much it. Anybody got any questions, you can DM me. Send me an email, amillionwins@gmail.com. Leave your full name and number. Whatever questions you got, I'll answer it as quick as I can. And that's it, man. Y'all enjoy y'all day. Have a good morning. Thanks for listening. Thanks for tuning in. Peace.